Welcome to Investors Insights. Our topic today is Rattling Cages. I think we've got some great information you will benefit from today in relation to your financial blueprint and your portfolios. Folks, 2022 has not been dull, and we still have some months to go. Joining me today is Bobby Norman, Ty Miller, and Adam Van Zant. And we've got information that you can continue after the vlog on our social media, LinkedIn, Twitter, Facebook, our podcast on YouTube. We're trying in multiple ways to communicate what's going on throughout the week. So let's start off because the debate that took place today is where we came up with rattling cages. Bobby, interest rates. It's on everybody's mind. And later this week, the chairman of the Fed, Jerome Powell, speaks in Jackson Hole. A lot of people will be watching that. So talk about it.
Yeah, so last week on the vlog, I talked about the market breaking through the important 90% number of stocks above their 50-day moving average, which historically is a very positive development. So this week, I want to talk about a topic that could lead to further volatility in the market, and that is higher yields. Rising yields could be a threat to the recent rally that we've seen in the stock market the past few weeks. And as you can see in this chart, the 10-year yield has rallied. The 10-year yield has rallied higher the past week, which is one of the reasons that the market pulled back slightly last week. And as you can see on the left-hand side of the chart, the 10-year yields have been on a decline since June, which coincided with a stronger market. So lower yields have helped drive the market higher in recent weeks. And we were a little surprised to see yields spike last week as some inflation numbers came in lower. So we're watching yields carefully this week to see if higher yields will lead to a market pullback and further uncertainty.
Yeah, and also I think last week we had one of the members of the Fed say, why don't we just go on and increase rates 50 to 75 bips and get it over with and not be dealing with raising rates in 2023? And you're right, Bobby, that had an impact on Friday, and we're watching it closely. So, but simultaneously, throughout this year, we've talked about corporate earnings. Bobby, you've emphasized that, and Ty, you also brought it up today. You want to elaborate on how we may be having interest rates go up, but corporate earnings continue to show positive signs?
Yeah, absolutely. So I'll start on the rally that Bobby mentioned. So, lately over the last 40 days or so, we've seen a really good rally, up about 17% in the S&P. And so if you check out this chart, you'll kind of see how that lines up with some historic rallies in not so great markets. As you can see, typically over the next 20, 65, 125, and even 250 days, we're talking trading days, talking about a year plus. This has led to some good performance. The one outlier being 2001 kind of fooled everyone. So, hopefully we're on a good trajectory there. And what's been the driver of this move has been earnings. Aggregate EPS growth for the S&P 500, 9.7%, well above estimates coming into earnings season of 5.6%. Revenue has also been great. It's not just energy driving this move. As you can see here, 8 out of the 10 sectors reported good earnings and good revenue. 90% of the companies have reported so far. So we're almost through this earnings season. Not too much is going to change now. Overall, I would consider this earnings season a good win.
Yeah. So rattling cages. 1 minute we hear about yields or rates going up. Next minute corporate earnings are going up, and there's a battle between the bulls and the bears taking place. And so it definitely is, as news announcements come out, it rattles cages of this market. So Adam, you're tracking the different indices. Talk about that, because it's a great way for our viewers to track the volatility and the different break points or support levels, resistant levels in this market in relation to the fundamentals that Bobby and Ty just talked about.
Of course. And we talked about the pullback of the S&P 500 last week. Most of that damage came on Friday, being down a little bit over 1% with a close of 4,228. That gives us a new resistance level of 4,260 with a new support level of 4,200. Despite the pullback that we saw last week, over the last month, all 11 sectors have been in the green, have been up, and the 50-day moving day average is currently sitting at 3,966. So from an intermediate standpoint, and what I mean by that, over the next month to 3 months, That's going to be an important number to keep an eye on to make sure that could potentially become our resistance level and one that we really want to keep an eye on while we see some volatility in the markets.
Yeah, and I really appreciate that information, Adam. And to our viewers, let me say this, the information that Adam gives as news comes out, whether it's interest rates going up or corporate earnings going up, Adam's information gives some sanity to that volatility in a way that people can pinpoint or watch the markets to know kind of where we stand, as an economy and market volatility. So I really appreciate that. Folks, we hope you benefited from this. I also want to take time to just thank all of you who continue to reach out to me about speaking at events. This Wednesday, August 24th, I'm speaking to the Hoover Small Business Alliance. Great honor, great opportunity. And those of you that have asked me about your civic group or other groups you belong to, just want to thank you for that, as well as those of you that are passing our blog on to family, friends, colleagues at work. We want to make a difference in people's lives. Every day we come in this building, we're striving to make our clients' lives better, richer, fuller. And we hope you know that and that you can see it as we try to educate and provide as much information as possible. Have a great week. We'll keep you updated.